Just like you have different outfits for different occasions, you need different assets in your portfolio for different market phases. Different asset classes, like different articles of clothing, equip you to handle any market weather. But what exactly are asset classes? An asset class is a grouping of investments that exhibit similar characteristics. Each asset class offers distinct benefits and attributes which make it suitable for a particular investment duration, risks, and returns profile. Equities are commonly known as stocks. When you buy a stock, you become a partial owner, getting a share in the company's success through rising stock price and dividend payouts. Historically, equities have delivered inflation-beating returns in the long run. Thus, you can invest in this asset for your long-term goals such as retirement planning, child education, etc. However, equities are slightly more volatile due to economic conditions and investor emotions. Fixed income asset or bond, on the other hand, is considered more stable asset class. A bond is like a loan agreement between an investor and governments or corporations. In return of lending money, you receive fixed predictable interest payments at regular intervals. This asset is ideal for capital principal preservation. Moving on to commodities. These assets could offer the potential for significant rewards if demand spikes. But commodities also carry high volatility due to unforeseen events and global market forces. Within metals, we have gold, which is often seen as protection against inflation. While moderately volatile compared to stocks, gold prices can still fluctuate. Today, you can invest in gold through online as well as a physical route. You can invest in these assets either directly through exchanges or even through mutual funds. In addition, there is real estate, which means owning land and anything built on it, including residential or commercial properties. Then we have collectibles such as art, stamps, rare coins, etc. that are known to hold their value through time. Lastly, there is cash and cash equivalents, which include physical money and safer short-term instruments. And apart from these traditional asset classes, we have alternative assets like private equity, hedge funds, venture capital, etc. that offer distinct return and risk profiles. These can enhance your portfolio diversification and help you reduce overall risk. There are various factors we should consider when categorizing assets, including liquidity, associated risk, volatility, and investment size. Evaluating these factors helps us to build a diversified portfolio and manage risk effectively. As different assets perform in different market conditions, it is wise to diversify your investments across different assets. Because like the financial experts always say, do not put all your eggs in one basket. It is better to diversify your investment across assets and march towards the financial goals. Also, it is essential that your asset allocation aligns with risk tolerance, which reflects your willingness and ability to accept fluctuations in investment value based on your financial goals and time horizon. Since risk tolerance can change over time, it is crucial to periodically review and adjust your portfolio to ensure it remains aligned with your investment goals. Traditionally, Indian investors have preferred fixed deposits, public provident funds, etc. for reaching financial goals. But is it an ideal way? Maybe not. So the next time you plan your investments, pick the asset class more suitable to your goal, risk appetite, and investment tenure. And to know where to buy and sell these assets, watch our next video in line.
सोच कर समझ कर इन्वेस्ट कर